Also in Study Objective 5-1, your authors refer to two different types of inventory systems, perpetual and periodic. We'll be looking at journal entries a little bit later in this chapter. But in the perpetual system, this is the type of system that you'll see being used at most larger grocery stores, department stores, any place where at the checkout they're scanning your goods with an optical scanner. You know they have a perpetual system in that case. And a perpetual system gets its name because the company is perpetually or continually keeping track of how much and exactly what particular items of inventory are coming in the door and what's going out at the checkout. So take a grocery store today that scans your goods at the checkout. At the checkout, it's amazing. Every time goods are scanned, two journal entries are being recorded. One to record the retail amount of sales that are being charged to the customer, and another entry to record the goods that are going out the door. These companies also have what's called an inventory subsidiary ledger, which if you just were talking about an old-fashioned manual system, that could be a separate page in a 3-ring binder for every different inventory item, every different type of product the company has. And every time they buy some of that product, they increase that page of the subsidiary ledger. And every time they sell it, every time it goes out the door at the checkout, it comes off of that page of the subsidiary ledger. So if companies are keeping track of what they're buying and the exact items going out the door, then their computer system is able to keep track of how much inventory they supposedly have on hand of every single different type of product that they have. This is the type of system that most companies would love to have. This is what everyone wants to be able to do. And what holds some companies back, though, is the investment in those optical scanners. So we still do see today some companies with the old-fashioned periodic system. In this type of system, they can keep track of the goods that they're buying, but at the checkout, they can't keep track of the items going out the door. So see if you can think of a company where at the checkout, all they do is key in the retail dollar amount that they're charging you. And you end up walking out with a cash register receipt that just shows dollar amounts. It doesn't list items that you've purchased. And the company really is not keeping track of what particular items are going out the door. This means then that at the end of the accounting period, the company has to calculate what has been sold. And down here at the bottom of the sheet, we show a brief calculation. Beginning inventory plus they're keeping track of what they bought. So that gives them everything they had available for sale. At the end of the accounting period, they go out through the store and count what's left. Then they do a subtraction and assume that if it's not there anymore, it must have been sold. Now, I want to tell you that in Chapter 5, we are certainly going to be emphasizing the perpetual inventory system. There is an appendix at the end of Chapter 5 on the periodic system, Appendix 5-A. You will not be responsible for any of the journal entries related to the periodic system that are found in that appendix. However, we will have a study objective 5-5 that will again revisit this calculation of cost of goods sold. I'd like you to know how to do that. But basically everything in Appendix 5-A, as far as the journal entries for periodic, you will not be responsible for. All of the journal entries that we're going to be doing, and there will be a lot of them, will all be related to the perpetual inventory system. Perpetual is truly what we're going to be emphasizing in Chapter 5.